So I'm Nicholas Bornodis of Capital Inc., and I would like to welcome you all to another very interesting session. This one talks about the rebirth of closed-end funds coming to the market and the outlook for the market looking ahead. We have with us a great group of panelists, and I would like to thank Clifford Cohn, who is moderating this panel for one more year. We have a great partnership, and we appreciate your being part of the event every year, as well as I would like to thank all of you for being repeat participants to our event. And of course, for doing a great job for the closed-end fund market. So without any more comments from me, I will turn it over to Cliff, and thank you again.
Great, thank you so much. I know I speak for everyone. We were all excited to put on dress clothes today for the first time in 6 months for me. So happy to be here. Let me very briefly introduce who's with us. Mark Charles, who's a director and member of the Equity Capital Markets Division at Wells Fargo, with a particular focus on new issue closed-end funds. Patrick Galley, who's the CEO and CIO of RiverNorth. He's been in the industry for a long time and is also a large institutional investor in closed-end funds. Bill Meyers, who's been with Nuveen for 30 years and leads its closed-end fund development unit. And Finbar Ward, who is part of the traditional investment products team at Morgan Stanley Wealth Management and has been involved in this space since 2016. So, these last few years have been really interesting for closed-end funds, and there's been an evolution of sorts. And I think maybe beginning with Patrick and Bill, as sponsors, just wanted to kind of open it up by asking, what are kind of the most important trends you've seen in this space recently? I have my own ideas about what those are. I won't color your thinking, but maybe if I could start with you, Bill, just to get some color on what you think's been really critical to the development of these new products.
Sure. Thanks, Cliff, and thanks again, Nicholas, for putting together the panel. I always look forward to this conference. It's a new and different world, so thanks for coordinating it for everyone. In terms of trends, Cliff, I really see two dominant trends that have happened. One is on the product side, and the other is on the market side. With respect to the product side, there's a couple features of the new trend and the shift. One is the imposition of terms, and we saw terms being introduced many years ago. Nuveen had some term funds in the 90s. I know both BlackRock and an issuer called Intercapital had term funds, but now every fund that's coming out has a term attached to it, and we've seen the terms shifting out from 5 to 12 years and maybe soon beyond that. But a term is a feature that's seems to be, at least for the time being, a permanent part of closed-end issuance. And again, that hasn't always been the case. Closed-end funds were issued in the States, I think, back as late as the 1890s. There's an old closed-end fund, Tricontinental, that was issued in the 1920s that's still out there. Nuveen issued its first fund in 1987, which just had its 33rd birthday. But every fund issued now is likely to be terminated prior to any time like that. Another major structural change is the fees, and this is really important because the fees historically have always been embedded within the offering price. So those fees, when I started at Nuveen, were probably between 6 and 7%, and that came out of the proceeds of the fund. Starting in 1999, those fees were down to 4.5%. But again, that came out of the NAV of the fund. And as a result, funds immediately traded, initially at least, at a premium to the underlying NAV. Those fees shrunk and are now no load, or those are paid entirely by the sponsor. Advisors are still earning fees, and banks are still earning fees, but that's paid by the sponsor out of pocket. So it's been a big change for the sponsor, but it's also been pretty beneficial for the advisor. I'd say one other big change in the market relates to the advisor selling it. And we've seen more and more advisors wrapping their assets and selling or providing asset under management and fee-based services. And that's been challenging for the closed-end issuance side, the IPO side, because those types of accounts are generally not compatible with new issue offerings. So we've faced maybe a shrinking group of advisors in selling into that market, but I think at the same time, the lower fees have counteracted some of the diminished participation by introducing a lot more advisors who otherwise wouldn't have played in closed-end IPOs.
That's great perspective, Bill, and I think it shouldn't be understated that the immediate dilution to investors off of the NAV really played a part in secondary market trading after the stabilization period. Maybe I'll just hand it over to Patrick to get his thoughts as well, but thank you for raising those points.
Yeah, no, thanks, Clifford. I would echo Bill's comments. Obviously, I think those are the big shifts in the last couple of years as far as structure goes for closed-end funds. Fees being literally 100% paid now by the advisor. Obviously, the terms, we also had some target term trusts trying to return back $10 a share. Now you're seeing more of a trend towards straight term trusts, and those terms have extended from, we've seen 3, 5, 7, and now we're talking about 12. It's been a pretty consistent term. I would just add also structurally on those term trusts, there's a feature that's still a benefit to a sponsor of a closed-end fund, and that in the year before the term were to expire, the board of directors has the option to go out to shareholders for a tender offer. And it's 100% tender offer for shareholders, so everybody can tender their shares. And if the fund sponsor, if the fund's left with typically over $100 million or thereabouts, then the remaining portion can be perpetual thereafter. So I think that is a good structural feature for both the shareholders and then obviously the sponsor, because the fund is working and it's trading well and it's had good performance, because we do believe the closed-end fund wrapper is the best way to manage assets. Should you be forced to liquidate just because 12 years prior in a prospectus it was deemed that it should be liquidated? We think that is a good feature to have in there, is tender offer in the year before, and then from there, if you don't have over 100 million or whatever the level is, then the fund will liquidate and everybody will get their money back at net asset value. So we think that's a good feature as well. On the fee front, I think here we've shifted over the last couple of years. Some of the fees had been paid historically, as Bill pointed out, it was 100% paid by the investor. Had funds coming out, 5, 6, 7% premiums to their net asset value. Well, we're not only are we a sponsor of closed-end funds, but we're also traders of closed-end funds in the secondary market. And when we have a fund trading at a 6% premium to its net asset value, it immediately creates a supply-demand imbalance in the marketplace. There's not too many people in the secondary market that want to pay $1.06 for $1 worth of assets. So naturally, the fund started to sell off, and once they got below net asset value, it's been already a bad experience for the investor. And in that, next thing you know, you've got tax loss selling season in front of us, and it puts more pressure on the market price. So now that they're coming out at net asset value, our experience has been, you get more advisors, and even the fee-based advisors that Bill has been talking about, saying, I'd like to buy this in my other accounts. And I think that's one challenge for the industry, is for those fee-based advisors to be able to buy closed-end funds at IPO. I don't think this is maybe a challenge for you, Clifford. The attorneys have figured that out yet, but I think that is somewhere we need to look going forward, is how to have fee-based advisors to be able to buy closed-end funds at IPO, because they're coming out at net asset value. And I would just also add, closed-end funds coming out at IPO, where 100% of the fees are being paid by the sponsor, and the broker is being paid by the sponsor. That's actually, if you think about why we got into this position, it was because of the pressure on DOL. And here we are, fee-based advisors, obviously they typically charge an asset-based fee year in, year out. Let's say for the sake of argument, it's 1%. Well, if you buy a closed-end fund and you're in the secondary market and you're charging a 1% fee, you actually were better off to buy it in a brokerage account, get your commission paid from the sponsor. The client is better off in this case. So we think there's still, the brokerage of closed-end funds makes a ton of sense.
And Patrick, just given RiverNorth's perspective as an institutional investor, having seen the evolution of this product over, a significant amount of time, how have the changes we've just discussed influenced your thinking about, where you commit capital and how you think about secondary market trading in these products?
Yeah, that is an interesting perspective because yes, we're a sponsor, but also an institutional investor in the closed-end fund space. So, and I'll speak off the cuff because, the reality is a term trust that's expiring in 12 years is not necessarily making that much of a difference for us in the secondary market, 1 year in, right? Or 2 years in. It's more closer to when those trusts are getting closer to expiration. That becomes very interesting, especially if we can pick it up at a discount to its net asset value. So naturally, as the fund matures and it gets closer to the term, we become more interested, as do other investors, which naturally puts pressure on the discount and narrows the discount, and maybe even trades at a premium to its net asset value, depending on the asset class. So, we like that there's a lot of terms out there. We now have a diversification of asset classes and different funds in vintages that are maturing at different times, which as an institutional investor in the secondary market, it provides interesting ways to generate excess return by buying expiring funds in due course. Regarding the fees, that typically doesn't make that much of a difference to us, other than it's immediately at a discount if it trades off at all, right? Or again, if it had to sell off 5% before it was at a discount, and then it has a negative sentiment with investors. So here, if it's sold off 5%, it's at a 5% discount. In a lot of cases, it's also, the fund that's actually appreciating on a net asset value is the market price keeping up with it, and it's trading at a discount. So you've eliminated that spread as well. So again, if the fund trades up from a net asset value perspective a little bit and the market price is flat, it's still at a discount. We're interested, I would say, quicker in the secondary market of closed-end funds as an investor in the space.
Yeah, if I could add a little bit, Cliff, about the terms and in the pricing. Back in 2015, the IPO market was very, very challenged, and it had traded just very, very poorly after a series of deals. And what we realized is that we thought the market needed a couple things. It needed some ability to enable investors to get back and capture the NAV at a certain period of time. Obviously, the market would want it as soon as possible, like an ETF, for example, but as an issuer, you really can't do a 2 or a 3 year term. So we went out with our first product with a 5-year term with the expectation, or the objective rather, of returning the original NAV. So it gave the secondary market a couple variables that they could fix on in helping price the shares in the secondary market. And I think that succeeded in improving pricing. But we also did that on a product that had lower expenses up front. And the expense of that fund was 1.5 points, which was a significant reduction from the 4.5 points it was. But again, it seeked to create an endpoint in terms of time, but also an expected end pricing point. So we thought it helped the secondary market. As we've talked about since then, the fees have gone from 1.5 points for those deals down to 0 as the sponsors had borne that, and the terms have gone out. So as the market has become more comfortable again with the closed end, given the new pricing structure, it's embraced longer terms, which probably wouldn't have been possible in 2015. So we think it's a positive development for investors to have the lower fees, but also from an issuer perspective, it's helpful to have a longer term with, as Patrick mentioned, the ability to create a perpetual after a tender.
Yeah, and I guess the liquidity rule imposed by the SEC for open-end funds, has really put a lot of pressure on how open-end funds are managed, even more than before, just in terms of going through the liquidity, provide a daily redemption in those products. I think in some ways that's made closed-end funds even more attractive, to be fully invested, to really go after products that are generating yield in this environment. I guess what we haven't seen in a long time is equity-focused closed-end funds. I'd be curious if anyone sees those on the horizon.
I can start, Patrick. I was waiting for you to do it. We've seen some equity-based offerings if you include funds that have a covered call.
Yeah.
Override strategies. So BlackRock has done some of those with great success, and it's not a pure long-only equity strategy necessarily because there's an option override used to generate cash flow.
Yeah.
But what we don't see is necessarily a pure equity strategy off the bat without having some cash flow and some option override. So closed-end funds and their buyers, it's really dominated by the income investor and the investor seeking cash flow. And as long as I've been involved in closed-end funds for years and years, it's always been the case. You go into offices and everyone asks, well, what's the dividend on it? And I remember many years ago, we did an offering that I'm partial, but I thought it was the best, most thoughtful strategy in the world. And it had a low dividend rate because it was very focused on equities, and it was a higher paying dividend strategy, but we didn't use override, and we combined it with some debt. Concurrent in the market, which was another change where you had multiple deals in a given month. Concurrent in the market was a much more narrow, concentrated portfolio that frankly, I don't think it was as thoughtful a strategy, but it had a much higher distribution rate. And that fund did very, very well in the market. So it's tough to do an equity-only strategy, but it's not for lack of trying. I think the option override is a way to provide exposure to equities and still offer investors cash flow while doing it.
Yeah, I would just add, I think we have seen some more relatively pure play equity funds come to market in the last couple of years. Just recently, science and technology, healthcare, artificial intelligence. And also, what's interesting about those funds is they typically have a part of the fund is investing in private companies. So pre-IPO companies. And so this is a way to give, retail investors, financial advisors access to those, that type of asset class, without going direct. They're getting it in a pooled vehicle and by obviously professionals managing the fund. And then the option override, I think that is, part of a structural feature for the fund or strategy that is able to generate the additional yield if they want to implement that strategy. Some of them are implementing it, some of them are not. And I think probably that is another trend worth mentioning that, before it was all about meeting the yield, meeting what's the yield talk coming out. And I think now, especially with some of these equity strategies, it's more about what's the distribution rate. And those funds coming out with a level or a managed distribution policy that is set based off of, what they expect to be able to earn on a reasonable basis through net investment income and also realized and unrealized capital gains. And also being comfortable with, I think the market's more comfortable with part of that distribution policy potentially being a return of capital, and knowing that investors are going to get their own money back at net asset value is actually not a bad thing. And it actually, and this is our opinion, it's cyclical where that money then can get reinvested and buy that same fund at a discount. So it creates a self-fulfilling prophecy where that fund trades better relative to other funds without higher distribution rates, even if it is a return of capital. So I think that's also a recent trend that we've seen in the market that, underwriters, and we've obviously have two of them here, and the advisors are more comfortable with coming out right at IPO with a distribution policy rather than needing to earn that net investment income. Because I also think historically that's created an environment where it's also a lot of risk, right? Okay, I need to invest in the riskiest assets. I have to put on a lot of leverage. And, that didn't work with, a certain asset class that we saw in March and April this past year, where there was a lot of forced unwinding because they had too much leverage to maybe meet certain distribution rates.
Yeah, the consistency of the managed distribution has appeared to be an important component of these vehicles. So I don't want to ignore our other two esteemed colleagues here. Finbar and Mark, from your perspective as underwriters, gatekeepers to what we're really bringing to market in this space, we're far away, I think, from the world where we were bringing, 3, 4, 5 products a month. How are you guys thinking about, what you need to see, what you want to see in the products that are being brought to market now? What are the real important considerations from your perspective? Maybe I'll start with you, Mark.
Sure. And Cliff, thank you. Good to see all of you guys, and thanks to Nick and Capital Link. Look, the first thing that we look for in terms of an opportunity is the strategy differentiate. Is it something that's not in existence in the closed-end fund space currently? Or if it is in existence, how many funds are in that space? And, is there a trading at premiums? I think those are some of the things that we look for initially in terms of the opportunity. Then next, we would talk to our research team. We try to find out from them, WFA, particularly in terms of the sector, in terms of it being fixed income, equity. Is this something that would resonate with retail? Is this something that we can garner good potential interest in terms of the opportunity? And then the third thing, I think, in terms of what we look at is the secondary closed-end fund market. And I guess some people would look at that prior to whether it's differentiated or go to research. But in terms of the secondary market, if there's a significant number of funds that are trading at discounts, then it becomes more difficult to bring that particular strategy. But again, if there's a premium existing in that space, I think we look more favorably at that. And again, gauging where our research is on the opportunity, that gives us a sense, well, can we sell this? And not just can we sell it, but are we going to get pretty broad steps in terms of the opportunity that we're trying to bring? And the fourth thing I would mention, we Wells Fargo, we can't move forward on a transaction without the support of another lead. So obviously most of the transactions that we've participated in, obviously all of them actually, we partnered up with the likes of Morgan Stanley, Merrill Lynch, more frequently UBS. And that was helpful, I think, in being able to bring not just larger managers like Nuveen or BlackRock, but also smaller managers, potentially like RiverNorth, Angel Oak, some other smaller managers that I think have come to market with differentiated product, but might have been limited in terms of their access if we weren't able to kind of pull together our efforts in a case of UBS and Wells Fargo to work with them and bring them to market. So those are things that I think we look at in terms of the overall picture, the market, whether or not research is favorably disposed to us moving forward. And then, of course, again, the relationships that we're hoping to foster with our syndicate partners in order to bring new issuers to market.
So Cliff, I don't know if you want me to weigh in here, but I mean, I wholeheartedly agree when Mark talks about differentiated and unique proposals and or strategies. We're always looking for those, right? Because they're what keeps advisors interested, and that they're the types of strategies that really draw in more interests or more users into this space. And in that context, I think a lot of it has to do with timing. So the proposal or the strategy has to be the right one for the current market environment. And to Mark's point, I mean, at Morgan Stanley, it absolutely has to be supported by firm research, and not just firm research, but research across the street. The second thing that we would look at is the manager. So is the manager or the sponsor the right one for that strategy? Do they have a track record, not just in precedent closed-end funds, but maybe in other products that also have daily liquidity? And then finally, Mark touched on this, is distribution. Are they able to sell this product in our system, or can they partner with a reputable third party? And it's not just about selling product. It's also about educating our advisors on the strategy as well as the wrapper. And in addition to that, we also look to do business with managers that provide support in the secondary market. So in recent times, such as the COVID-induced volatility cycle from February up until April, we received an awful lot of calls from advisors looking for opinions specifically from managers in relation to how funds were performing during that cycle. So secondary support is paramount in our decision-making process.
Yeah, and I guess, you raise a couple interesting points, both of you, about your considerations. Thinking a little bit about managers who may not, be the RiverNorths or Nuveens or BlackRocks of the world, managers who don't have a lot of product out there, but are really thinking long and hard about entering the space. How do you kind of view, or do you view the considerations being any different, for a first-time manager that perhaps has a very good track record, but just not in a, publicly traded closed-end fund? And how do you think about those types of opportunities?
So maybe I'll start. When you talk about unique sponsors, and I guess individuals or firms rather that are now trying to get access to the closed-end fund space, the question is, how much do they understand retail? And I think Finbar obviously alluded to this. What are their thoughts in terms of distribution, and how are they going to be able to distribute that product? So look, as I mentioned, we at Wells Fargo, we are open to different managers, small and large, of course. Getting back to my initial point, differentiation is key. If they are coming with a product that's not out there, if it's differentiated, if we feel confident that research would be comfortable with the opportunity, those are things that we look at in terms of moving forward. And again, in terms of researchers, their comfort in terms of the opportunity, one of the big concerns for us is limitations in terms of stipulations. And if it's a transaction that's limited based on the steps that are going to come from retail, then that may limit us, irrespective of if it's a larger distribution opportunity or smaller firm. So those are some of the other kind of the issues that I would focus on. Again, distribution is key. The innovative nature of the opportunity. If we step back over 2 years, what we thought at the time when RiverNorth and Mackay Shields were coming to market with a fund that was going to be invested in investment grade munis, plus the closed-end fund component to that, whereby RiverNorth, Mackay partnered on that fund at a real opportune time. It clearly was, I think, an opportunity, and we've subsequently seen a number of funds come into market similarly structured, at least from the RiverNorth team. While it was also mentioned here, we talked about equities in terms of what BlackRock and Allianz have brought to market. We're focused on the addition, the sizzle, so to speak, of adding privates to those opportunities. That's been somewhat of a differentiator, because here it is that these are opportunities that retail isn't necessarily going to get access to. So here is an opportunity they're going to get access to and not have to worry about, how it trades out of the gate. And we've seen great performance in terms of BlackRock. We've seen great performance in terms of the Allianz transaction. So some of those differentiations, I think, are key. I think that's what we're going to continue to look for going forward. And as Finbar stated, look, it depends on the general mood of the market. It depends on the underlying investment, the asset class, so to speak, whether or not we're going to be able to put together a syndicate that's going to be able to be successful in the market. So all those things, I think, are going to be key in terms of us making it to market with a new fund.
And I guess just, the tension between making this an expensive product for a sponsor to launch, in terms of picking up expenses that would have, in the past gone to investors. We've got a no dilution product essentially. And this is kind of a question that I see on our screen. What has the aftermarket performance looked like in these new iteration of funds? Have we seen trading closer to NAV, maybe far less dilution than we would see historically in a perpetual vehicle? What have been your observations around how these new structures have really performed in the aftermarket? And I'm opening it up to
Go on, Finbar.
I can start here, Bill. I mean, in general, funds that have terms attached to them tend to trend more towards NAV than perpetual funds. I mean, what we went through with the COVID-induced pandemic market volatility is obviously a very, very unique situation, Cliff, and probably, volatility like that comes into the market, I think, once every 8 to 10 years. But, the closed-end funds definitely experienced an awful lot of volatility in those months. A lot of managers were very proactive about setting up calls and talking to advisors. But when you look at them now compared to where they were 3 months ago, I think that they're definitely trading at in a much better place today. And I think that they make a more compelling case for the term structure than ever.
Yeah, if I could add to that, and I'm speaking from an issuer. I also speak from maybe on one hand, maybe a slightly different perspective from where Patrick sits for part of his position. But I look at closed-end funds as a really important longer-term part of an investor's portfolio. So think about an investor who has an overall allocation across equities, across debt, different types of fixed income, and think about maybe including within those predetermined allocations just a sleeve of closed-end funds. So carving off a slice of that and apportioning it to closed-end funds. What those investors will get is a better income and cash flow approach, but without a material pickup in risk. So we think the risk return profile for holding closed-end funds over a longer period of time is really beneficial for the cash flow of the portfolio. Now, there are trading opportunities, and I think Patrick can speak to those, because certainly we saw the market get hit significantly in March. And sadly, I think for Patrick, they were the misfortune of being in the market for an offering at the time that the market had that volatility. And as I saw that, I thought, if not for the grace of God, go I. And we pick a product that we think has integrity, that makes a lot of sense, but you don't get to pick the market you're in and what happens. But they got it off. But again, I look at closed-end funds as being a more longer dated holding for investors who can deal with maybe increased volatility over shorter periods of time. We think they'll be rewarded with decent performance over the long run.
And maybe Patrick, before you jump in, just being mindful of some of the questions we've received, and Bill just kind of, I think, touched on this, but thinking about closed-end funds versus, say, an ETF or a traditional mutual fund, why is this market and why are these products, compelling?
Yeah, I mean, I think March is a prime example, right? I mean, we saw, discounts in closed-end funds got to extreme levels because of forced selling, but we as an investor and an issuer, we view that as really a mark-to-market aberration, right? That's a temporary supply-demand imbalance. It's not permanent loss. And unfortunately, a lot of open-end funds and ETFs during that period of time, I mean, they were just faced with forced redemptions, forced selling, hit market lows, which created a lot of permanent loss. And, I think you really got to see some asset classes that probably are in the wrong wrapper and probably should be better off in a closed-end fund wrapper. And, if it wasn't for the Fed, coming in and bailing out and risk assets rallying back, it would be interesting to see where we would be today with a lot of those risk assets because, I think they got, that market or those wrappers got really bowed out. The Fed even came in and said, hey, we're even willing to buy ETFs in the secondary market. But closed-end funds, the wrapper, I think, makes a ton of sense. And going back to your earlier question, has the, getting rid of that upfront cost coming out at net asset value, I think they are trading better. The definition of trading better is in the eye of the beholder. Is it at a discount premium or is it from a total return standpoint? And what's interesting is a lot of the funds, again, that have had phenomenal net asset value performance might be trading at a discount, but they still have a phenomenal total return experience for the investor, and vice versa. The funds that maybe the net asset value did hit in March and April and they sold off, well, those market prices didn't necessarily, in some asset classes and some of the more recent funds, not necessarily sold off to any extreme level where they're trading at big discounts. And in fact, they're trading near net asset value. And I know Bill and his firms got, they had a fund that had, experienced a lot of volatility, but it's trading really well from a discount premium standpoint. We, as Bill was alluded to, we launched a fund at a perfect time where our net asset value skyrocketed because we had a fresh portfolio of cash to deploy in April. It's trading at a discount, but the net asset value has experienced a phenomenal run. So I think, that's it's interesting in how that market price and net asset value reacts. But at the end of the day, I think because we got rid of that upfront cost, you now you don't necessarily have the terrible experience, at least, that first 5%, which and have the negative sentiment right out of the gate. I don't think these funds have a ton of negative sentiment surrounding them. And that's why, even despite all the volatility, the current IPO market is still relatively strong, and the calendar looking forward is quite strong despite, the uncertainty.
Well, I guess time flies when we're having fun. I kind of wish this panel was longer, but I think we're at our allotted time here. And I want to thank everyone on the panel for so graciously joining us today and giving us our thoughts on this market. I think it's fair to say that this market, has experienced somewhat of a renaissance lately. And, I think there will always be competing products out there, ETFs. We've gotten some questions about ETFs. I have a whole view on that, which we don't have time for, so I'll leave you in suspense until next year. But I wanted to thank everyone for joining us, and I hope this was an instructive panel for those of you who are listening. Thank you.
Thanks, everybody.
Thank you.